Hello, thank you for joining me again. And episode 5 of Welcome to the USA Personal Finance Edition. My name is Hui-chin, and today we're going to talk about taxes. So it's not the most fun part of the personal finance we care about. Most of the time we want to know how much we have left, not how much we're paying to the government. And people want to minimize what they're paying to the government as much as possible. But whatever camp you're on, you might have come from countries where the tax is even higher in the US, and you might think, oh, the US actually doesn't tax enough for public services. However, today we're just going to talk about the general tax system. We're not going to talk deep into tax strategy because it will become very complicated. So I want to keep this as basic as possible for people who's just trying to understand this system for the first time. And you will be able to follow as you going through the same progression that we started in the beginning of the series. We talked about how to get yourself set up. You need to have a good some credit history, not necessarily a good credit score, but some credit history to help you set up. And then we talked about, okay, now you set yourself up with apartment, with cell phone, with internet. You found a job, great. And then you get your first pay stub and you notice all the things that's being taken out. So last time we talked about Social Security and how the systems run. And today we're going to talk about the other big deduction that's coming out of your pay stub, which is income tax. And there are also other type of taxes. So I'm just going to share with you quickly. All right. So before I go into all the different taxes that the US currently impose on individuals, there are two primaries. First, I'm not talking about companies' taxes. So if you run your own company, if you're self-employed and you have questions about how the business is taxed, whether you're taxed twice, all of those will not be covered in today's episode, and it will be something more advanced. Perhaps I will cover in the future if they're interested. Okay, and the second thing is that U.S. tax an individual's worldwide income. So what that means is that no matter where you live, as long as you're considered a U.S. person, I'll explain what that term means. If you're considered a U.S. person, then when you report annually of your taxable income, you need to include all the income you earn worldwide, not just from the U.S. So U.S. person, basically, if you're a U.S. citizen, you're a U.S. person and in IRS eyes. However, if you're a U.S. Green card holder, a permanent resident, you're also a U.S. person. That doesn't change whether you live in the U.S. or not. So let's say you're only a green card holder, but you're accompanying your spouse or family overseas. And even though you are a U.S. resident only, you don't live there, you still report your taxes annually, and it's on worldwide income. So the income could be where you're earning from another country, it doesn't matter. You have to report it on the U.S. tax return. And the third type of U.S. persons is if you're just a visa holder and you're physically in the U.S. So you're earning income in the U.S. on a work visa. So you obviously will report your U.S. income. However, because you're considered a U.S. person, if you for some reason still running a company overseas, or you're getting some investment income from your overseas investments, you also have to report that on your U.S. tax return, even though you're only a visa holder. So those are all the ways the government can get you on the income tax part. And you will notice that in the box below, I'm including transfer tax, which is a completely separate thing. But right now, what I'm mentioning earlier is just on the income tax part. All right, so going back to the high level. We talked about payroll tax already, mostly in episode 4 about Social Security. Basically, as long as you have earned income in the US, you will pay payroll taxes. And payroll tax basically funds the U.S. Social Security and Medicare system. You basically, it's not something you can avoid unless you work overseas. So if you're a U.S. citizen or a green card holder and you work overseas, presumably you're paying into another country's system. So that is why you may not be paying payroll taxes, but you might actually be paying into a public pension in another country that's actually a higher contribution rate. There is a way to combine those two credits in one country or the other under different systems, and I mentioned this a little bit in episode 4, so be sure to go back and check it out if you haven't. So the next part is income tax, like I mentioned. In US, tax you on worldwide income. And when I say US, it's generally at the federal level. So it doesn't even cover the state and local. So not every, as you know, US have 50 states. Not every state has state income tax. Many states have property taxes. If they don't have income tax, and they might have higher property tax, they might have higher general sales tax. But it's basically something the state decide how they're going to fund their state government. So some state has a combination of income, property, sales tax. Some state doesn't tax you on income at all. So many people, especially if they're temporarily overseas, they may want to basically declare that they live in a state that does not have state income tax. Of course, there are different ways of how you may or may not be able to do that, and I'm not going to cover it here. And you might notice that some states and some localities, you actually pay an additional taxes to fund the local government. So that might include county, city, towns. Basically, a lot of those places usually are in a state that also have state income tax. So you'll find that there are different levels of income tax getting added onto your income tax bill. So we talked about payroll tax for individual. If you're just an employee, you pay 7.65% of your earned income. And on the income tax part, like I said, every state has different tax rate, local have different tax rate. On the federal side, there it is a steps. So it can range from 0%, meaning you have very, very low income, and to currently it's 37%, I believe, as the highest bracket. And because there is this interesting thing that happened in 2017, is known as the Trump's tax plan, which was passed to go into effect since 2018. There is a large increase of tax credit for people who have children. So I want to mention this particularly. So normally you would think about income tax as just, oh, this is how much I make. There are certain deduction, I can take out from, let's say I make $50,000, but everybody gets either a standard deduction or they have other types of deduction they can throw in. Let's say we just use the standard deduction for a single person is $12,000 in 2018. For married filing jointly is $24,000. So let's say if you're single, you only made $50,000, and before you apply the different brackets on your taxable income, you actually get to take out $12,000 from your $50,000. So you're only getting taxed on $38,000. So that's generally how deductions work. However, there's also another thing called tax credit, and that's generally much better for income tax reduction purpose, because the tax credit is applied on the tax liability after we calculated the taxable income. So use the previous example. If you have $38,000 of taxable income, let's say after we calculate everything, you have $5,000 worth of income tax that you need to pay. However, you also have a dependent. Let's say you have a child, 2 years old. it doesn't really matter whether 2 or 4. There's a maximum age you can claim child tax credit, but let's just say that, in this case, you can get to deduct $2,000 of tax credit because you support this child. So instead of paying $5,000 in taxes, you only pay $3,000 in taxes. So you can see that $2,000 of tax credit kind of equals a lot more in deduction versus credit. So I just want to mention that. So for people who have a lot of children, they would find that in the new system, their taxes get reduced dramatically. However, this is not to say to have more children. So just trying to mention the difference between a deduction and credit. But for most people, it should be the idea of the new tax law is to just simplify it. So for majority of people, you do see it simplified, but there are still a lot of complications in terms of tax strategy and how to take advantage of those things. We will not be able to cover all of that, but the general idea is that there are 3 levels of income tax. Basically, you have to, because you declare worldwide income on the federal tax return, most of the states, if you're considered a state resident, you then pay income taxes on the same worldwide income in the state as well. So, but different states have this different way of treating foreign income, so be sure to check out how your state treats it and also in the locality. Okay, so then the last one I'll briefly mention is transfer tax. So basically, it's called transfer tax because you didn't make the income. You either receive or gift somebody your assets. So it could either be cash, it could be properties, it could be securities, whatever. So the difference between gift and estate is that gift is, when you're alive, and estate is whatever that's left when you pass away that's still under your name. It's in your estate and you will pass on to your heirs. So those are transfers of your assets, and they're actually taxed in the US as well. Although in the new 2017 tax plan, which is also had gone into effect in 2018, the combined gift and estate tax exemption, but basically how much you need to transfer over your lifetime in order for it to be taxable, has been increased to, I think, 11.5% in 2018, and it's actually increased in 2019 as well. So as you can see, unless you're the ultra high net worth, this might not be something you care about. One thing you do need to know is that there is a smaller threshold, which is called annual gift tax exclusion. So if you have transfer assets, like you gift somebody over $15,000 a year, then you will actually have to file a gift tax return, even though you will only be taking the exemption amount that's available to you, the 11.8% is available to you. So you do not actually pay taxes when you file this return, but you need to file a return to keep track of how much those exemptions that you have taken. So for example, let's say you gift your son $20,000, then you might have to file the gift tax returns for $5,000, even though you're gifting. It is not taxable. So you will see some of the tax advice on if you're gifting to any given person, can keep it under 15,000 limit, so you don't actually have to. That doesn't eat into your exemption amount, and you don't have to report it. The other thing to mention is that there are things that doesn't count as gift. For example, if you pay for your son's college directly to the college instead of gifting your son the money to pay for college, then it's not considered a gift. So a lot of times when we're basically supporting dependents or even like our elderly family members or anybody in your family, it may not be considered a gift depending on how you treat it. So I will not be able to get too much in details into how it's treated, but just remember to double check whether gifting money directly to another person is a good idea, or there are other ways that you can structure this intentional gift. All right, so those are the 3 types of taxes that you might need to be aware of. Of course, I will not be able to go into everything today, but the idea is for you to know what to research when you encounter something. For example, if you're getting inheritance from overseas, is it taxable? I can briefly tell the answer is generally it's not taxable because in the US system, when you're a receiver of the gift, you do not get taxed. It's generally the person who's gifting that's taxed. However, because it's a foreign gift, it's a good segue into the plus sign underneath the graph that I mentioned there is reporting of foreign assets. So if you are gifted, let's say $10,000, and from your home country, and you do not, it's in, let's say it's 10,000 euros, and you don't want to take it to the US because there's no point. So 10,000 euros, probably around 11,000-12,000 US dollars right now. And you might have account that you kept in your home country, and just, well, I have this money sitting there, then when I go back I can spend it. However, now you encounter this issue called reporting of foreign assets, because the US government wants to know all the taxpayers whether they have foreign assets, so they know to look out for the foreign income that you might be earning from your investments that you're not reporting on your US income tax return. So in this example, even if you only have 10,000 euros in your bank account, let's say in Germany, you actually have to report it on 2 different systems potentially, both on one of the income tax form and also on F.5, which is a reporting system that's for the US Treasury. So it's not even with the IRS. The idea, like I said before, is so that they know your assets overseas, so you're not avoiding paying income taxes. And also there are some anti-money laundering I guess ideas behind it when the law was put into effect. So I'm sure a lot of you already heard about this complication that makes immigrants to the US, or people who have dual nationalities, or US citizens moving abroad. Like the US government's rules on reporting has made all of our lives more difficult. But I just want to make sure that if you have never heard about this before, remember to research whether you meet the limit of having to report this kind of assets. There are some assets type you don't have to report, some do. So make sure you do your own research or work with an advisor, a tax advisor or financial advisor that can tell you whether this kind of reporting is needed. Like I said, if you need to file a US tax return, it's very likely that you also need to report foreign income. So that might basically bring out a can of worms by reporting your assets overseas if you have never reported your income from the assets overseas. But I just wanted to throw it out there so you understand that all the responsibility that you have, which is basically summarized in this chart. So these are all your responsibilities. I cannot tell you how to avoid legally or to come up with different strategies to coordinate with your perhaps foreign tax responsibilities. However, one thing I can tell you is that at least on the income tax part, if there is an income tax treaty between the US and the other country, they usually have some coordination that avoid double taxing. Even if it's between US and another country without a tax treaty, there are some certain ways that on the US side, they can help make sure that you're not double taxed. So those are there are two ways. One is called foreign earned income exclusion. The other one is called foreign tax credit. So those are also very complicated. So those are the terms that I want to throw out there if you have never heard of that, for you to do more research as well. And if you have more questions, we're welcome to bring it to the Q&A section. Once we finish the last episode, episode 6, which is when we're going to talk about insurance, which is another very important topic. So I want to encourage you to, if you want a checklist of the things you might want to do, go to this address, moneymattersforglobetrotters.com/welcomeusa. And there will also be some extended readings for you to do if you want to learn more about any given topics. And I assure you that's definitely worth your while, especially on the tax part. A lot of it is more for your awareness, so having something in writing might be helpful. All right. So I hope you enjoyed today's episode. I know income or taxes in general is a topic that a lot of people are interested in. So, but it's definitely not enough time through in 15 to 30-minute video to cover everything. But I hope that's a good general overview for you to do more research. And I look forward to getting your feedback, and see you once again on the last episode of this beginning of the series when we're talking about insurance. And I look forward to seeing you in the next episode. Bye.